Hello and welcome to Investing in Knowledge. Financial analysis is essential when investing. In today's video, we will learn the most important ratios to analyze companies, and we will carry out a financial analysis step by step. This will allow you to find good companies and improve your research process. When carrying out a financial analysis, it's important to master these ratios, since they will allow you to distinguish if we are dealing with a quality company, if its financial position is healthy, if it's managed efficiently, or if it's offered at an attractive valuation. I have classified them into 5 categories and filtered the most relevant ones. Let's start with profitability. Profitability ratios give insight into a company's efficiency at generating profits from business operations. The margins measure how much of every dollar in sales the company keeps as profit. They are expressed in percentage and calculated by dividing profit by sales. Gross profit, EBITDA, EBIT, and net income are the most relevant. ROE, or return on equity, measures how efficient is the company at generating income from its equity financing. Above 12% is considered very good. The more, the better, as long as debt levels are healthy. It's calculated by dividing net income by shareholders' equity. ROA, or returns on assets, measures how efficient is the company at generating income from its equity and debt financing. Above 8% is considered very good. The more, the better. And it's calculated by dividing net income by total assets. Great! Let's move on to practicing what we have learned so far. To calculate the margins, we take the gross profit and divide it by the revenue. Next, we calculate the EBITDA, which is the sum of operating income plus depreciation and amortization. So we open parentheses, select operating income plus depreciation and amortization. We close the bracket, divided by revenue. The EBIT margin is calculated by dividing the operating income by the revenue. And finally, we have the net income, which is net income divided by revenue. As you can see, the EBIT and net income margins are quite high, so we are in front of a good company. To calculate the return on equity, we take the net income and divide it by the shareholders' equity. And to calculate the return on assets, we take the net income, we divide it by total assets. Okay, so we have both numbers, 19% and 11%, which means that we are in front of a good company. Great, let's continue with the next ratios. Leverage. Leverage ratios measures the financial health of a company and assess its ability to meet its financial obligations. Debt to assets ratio measures the percentage of debt in a company's capital structure. More than 50% could be considered as dangerous, but it all depends on the quality of the business. The next ratio is net debt to EBITDA. Net debt to EBITDA shows how many years it would take for a company to pay back its debt. More than 2.5 times could be considered as dangerous, but again, it depends on the quality of the business. Liquidity. Liquidity ratios refers to a company's ability to pay its short-term obligation. Current ratio measures a company's ability to pay off its current liabilities with its current assets. Less than 1 time could be a warning sign. Efficiency. Efficiency ratios measure how efficient a business is regarding its operations. Asset turnover shows how efficient businesses are at generating sales from their assets. 2.5 times or more could be considered as good, but it depends on the industry that the business operates. It's calculated by sales divided by total assets. To calculate the debt to assets ratio, we have to sum short and long-term debt. So we open bracket and we add short-term debt plus long-term debt, close bracket, and then divided by total assets. To calculate the net debt to EBITDA ratio and avoid making a formula too long, we can simply link the calculation that we will do later and divide it by EBITDA, which, as a reminder, is the sum of EBIT plus depreciation and amortization. To calculate the net debt, we sum short and long-term debt and subtract cash. We end up with 0.8 times, which is a low ratio. To calculate the current ratio, we take the current assets and divide it by current liabilities. This gives us 1.9 times, which is quite good. To calculate the asset turnover ratio, we take the revenue and divide it by the total assets. Very well. Before going into valuation ratios, we must know the market data concept since it's vital to value shares. Market cap or equity value is the market value of a company attributable to equity investors. It's a measurement of a company's size. It tells you how much the market is willing to pay for its shares. It's calculated by multiplying the number of shares by the stock price. It doesn't take into account the capital structure. Enterprise value or firm value refers to the market value of the entire firm, which includes the capital structure. It tells you how much will cost to buy the entire firm, assuming the debt that the company owes and receiving the cash in the bank. It's calculated by summing the market cap plus debt minus the cash. The number of shares outstanding are all the shares of a corporation that have been authorized, issued and purchased by investors. Earnings per share or EPS indicates how much money a company makes for each share of its stock. It's calculated by dividing the net income by the number of shares outstanding. To calculate the market cap, we multiply a stock price by the numbers of shares outstanding, and then we add the net debt to arrive to the enterprise value. To calculate the earnings per share, we take the net income and divide it by the number of shares. Now we are prepared to see the valuation ratios. Valuation. Price ratio or multiples are valuation tools to measure how expensive a company is. There are different types of ratios: price to earnings, price to sales, price to book, and enterprise value to EBITDA. When to use them? Well, it depends on the stage of the company in its life cycle. How to use them? Compare them with its historical averages and industry peers. To do a good valuation job, it's good to use different valuation methods and don't rely on just one of them. Price to earnings relates the company's price to its earnings. It is a versatile ratio, but is especially useful with mature companies with stable earnings. A high PE ratio, which is more than 22 times, could suggest that the stock is overvalued. A low PE ratio, less than 12 times, could suggest a stock is undervalued. It all depends on the quality of the business and growth prospects. It's calculated by dividing the market cap by the net income, or stock price divided by the EPS. Price to sales relates the company's price to its sales. It is especially useful with growth or young companies without earnings yet. A high price to sales ratio, more than 5 times, could suggest that the stock is overvalued. A low PS ratio, less than 1 time, could suggest a stock is undervalued. It all depends on the quality of the business and growth prospects. It's calculated by dividing the market cap by the sales. Price to book relates the company's price to its book value. It's especially useful with financial companies. A high PB ratio, more than 3 times, could suggest that the stock is overvalued. Less than 1 time could suggest is undervalued. It depends, like before, on the quality of the business and growth prospects. It's calculated by dividing the market cap by shareholders' equity. EBIT to EBITDA. EBITDA refers to earnings before interest, tax, depreciation, and amortization, and it attempts to represent cash profit generated by the company's operations. It's calculated by summing the EBIT plus depreciation and amortization. Enterprise value to EBITDA relates the company's firm value to the EBITDA generated. It's a versatile tool that can be applied to most of companies and industries. A high EB to EBITDA ratio, more than 18 times, could suggest that a stock is overvalued. Less than 8 times could be undervalued. Like before, it depends on the quality of the business and growth prospects. It's calculated by dividing the enterprise value by the EBITDA. When calculating the P/E ratio, we can use two formulas. We can divide the market cap by the net income, or divide the stock price by the EPS. As you can see, we get the same result. Price to sales is the result of dividing the market cap by sales. We'll continue with price to book. We divide the market cap by the shareholders' equity. And finally, we will take the enterprise value and divide it by the EBITDA. Remember to add the parentheses so that it is calculated correctly. We can see that the company is trading with a premium multiples. However, it could be justified since it is a company with high margins and returns. In addition, the company is in a good financial health. Congratulations! Now you know the most relevant ratios and know how to do a financial analysis. Thanks for watching the video and see you soon.